Cash ratio. The cash ratio measures a company's ability to pay off short-term liabilities with quick assets. Cash ratio equals cash and cash equivalents divided by current liabilities. The cash ratio, sometimes referred to as the cash asset ratio, is a liquidity ratio that indicates a company's capacity to pay off short-term debts with its cash and cash equivalents. Compared to other liquidity ratios, the cash ratio is a stricter, more conservative measure because only cash and cash equivalents are the company's most liquid assets that are used in the calculation. Cash ratio equals cash and cash equivalents divided by current liabilities. The following items can be found on the balance sheet. Cash includes coins, currency and demand deposits, plus checks, checking account and bank drafts. Cash equivalents are assets that can be converted into cash quickly. They are readily convertible and subject to insignificant risk. Examples include savings accounts, treasury bills considered among the safest investments since they are backed by the full faith and credit of the United States government, and any money market instruments. Current liabilities are the obligations due within 1 year. Examples include short-term debt, accounts payable, and accrued liabilities. Current liabilities can be found on the right side of a balance sheet, across from the assets. In most cases, you will see a list of types of current liabilities and the amount owed in each category. Then, you'll see a total figure that shows all of the current liabilities. What does it all mean? The cash ratio is a liquidity ratio that measures a company's ability to pay off short-term liabilities with highly liquid assets. It is a more conservative measure of a company's liquidity position. There is no ideal figure, but a ratio of at least 0.5 to 1 is preferred. The cash ratio may not provide a good overall analysis of a company, as it is unrealistic for companies to hold large amounts of cash. In general, a cash ratio equal or greater than 1 indicates that a company has enough cash and cash equivalents to pay off all short-term debts. A ratio of under 0.5 is considered risky, as the company would have twice the amount of short-term debt to the available cash. For example, a company with $200,000 in cash and cash equivalents and $150,000 in liabilities will have a 1.33 cash ratio. How to increase the cash ratio? Number 1. Control overhead expenses. Number 2. Sell unnecessary assets. Number 3. Change your payment cycle. Number 4. Look into a line of credit. Number 5. Revisit your debt obligations. How to reduce the cash ratio? Spend more cash wisely. Cash is a current asset. Spending more cash will automatically reduce the current ratio. A company can use cash to buy fixed assets rather than taking finance. Next, the operating cash flow ratio. What is it? How to evaluate it? And how to use this information to support you to be the greatest you can be. Thanks for watching this to the end. Click the link below to join us, giving you confidence around business and money.